The number exists. It's specific. And the second you cross it, compound interest starts working harder for you than you have ever worked for money in your entire life. But here's what nobody tells you up front. The number isn't what most financial advisors say it is. It is almost certainly lower than what you've been told. And the psychological shift that happens when you finally hit it is worth more than the portfolio balance itself. We're going to cover all three of those things today in order with real math, not vibes. Most people spend their entire career accumulating money without ever knowing what number they're actually aiming for. They have a vague feeling that more is better, and a vague dread that whatever they currently have isn't enough. That combination, fuzzy target, chronic anxiety, is a recipe for working until you're 68 with a bad knee and a 401k you barely understand. This video is about the exact number, the math behind it, why the conventional financial advice on this is broken in 3 specific ways, and what you actually need to do differently. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. They use oversimplified assumptions about inflation and market returns that can make your plan look 12 years more solid than it actually is. It uses BlackRock and Vanguard's actual modeling logic to expose the weak points in your plan. And I only ask for your email to send the report, so I don't store any of your financial data link in the description. Here's a metaphor I keep coming back to, and it's going to show up throughout this whole video because it's the most accurate mental model I found for this specific problem. Escape velocity. When a rocket launches, it burns roughly 90% of its total fuel in the first few miles, just fighting gravity, just barely getting off the ground. The physics is brutal and unforgiving, but the moment it clears that gravitational threshold, the equation changes completely. The engines don't need to work as hard. A small, efficient thrust in the vacuum of space covers vastly more distance than the same thrust on the launch pad. And eventually, you reach a point where the rocket is simply coasting. Physics does the rest forever. Your portfolio is that rocket. The number we're discussing today is your escape velocity. Below it, you're burning fuel, salary, contributions, budget, discipline, the whole exhausting grind of accumulation. The moment you cross it, compounding takes over. Every reference I make to this metaphor throughout the video points back to the same core truth. We're not talking about getting rich. We're talking about clearing the gravity. Well, in a few minutes, I'm going to show you why the sequence in which your returns arrive matters almost as much as the returns themselves. And it's the specific variable that can detonate an otherwise mathematically perfect plan. But first, here's why most people's target number is completely, demonstrably, arithmetically wrong. The mistake starts with how people define the number in the first place. Ask most 40-year-old professionals what they need to retire comfortably, and they'll say something between $2 million and $5 million, a number they arrived at by hearing someone on a podcast say it, or by multiplying their salary by some arbitrary factor their HR department handed them. That's not a plan. That's a feeling wrapped in a spreadsheet. The actual math comes from a piece of research called the Trinity Study, published in 1998 by 3 finance professors at Trinity University, Cooley, Hubbard, and Walls. It examined every 30-year retirement window in recorded U.S. market history dating back to 1926 and asked one question: what annual withdrawal rate allows a portfolio to survive the full period? The answer, subsequently stress-tested by multiple independent researchers across different time horizons and asset allocations, is 4%. If you withdraw 4% of your starting portfolio balance each year, adjusting for inflation, historical data shows your portfolio survives a 30-year retirement in roughly 95% of all modeled scenarios, including the Great Depression, the 2008 crash, and every major bear market in between. 4%. Which means the formula for your number is almost embarrassingly straightforward. Multiply your actual annual expenses by 25. That's it. That's the entire calculation. If you spend $50,000 a year, your number is $250,000. If you spend $40,000 a year, it's $1 million flat. If you spend $30,000 a year, which is entirely achievable in a wide range of American cities, particularly if your housing is sorted, your number is $750,000. Not $5 million, not $3 million, $750,000. and the math says you're statistically free. Now here's where it gets genuinely interesting. The Bureau of Labor Statistics Consumer Expenditure Survey from 2022 places average American household spending at $66,928 per year. Apply the 25 times rule, and you arrive at a FI number of approximately 1,673,000 under 2 million. And yet the cultural benchmark people repeat, you need 2 to 5 million to retire, keeps inflating the target by anywhere from 20% to 200%. Those extra years of unnecessary accumulation are years of your life. But the real error isn't the benchmark number. The real error is the input. Most people calculate their retirement number off their gross income, not their actual spending. And those two figures can differ by 40 or 50% once you account for taxes, savings that will no longer be necessary in retirement, commuting costs, work clothing, and the general overhead of employment. If you earn $120,000 per year but spend $65,000, you don't need 30 times your salary. You need 25 times your spending. That's $1,625,000 versus $3,600,000. That gap is potentially a decade of your life. And here's the reversal you actually need to hear because it reframes the whole problem. You think the issue is that you're not earning enough money. But the real problem is that your expenses are growing with your income faster than your savings rate is. Every raise that triggers a slightly nicer apartment, a newer car, a vacation to somewhere a little more aspirational, that raise also quietly and permanently increased your FI number. You ran a faster mile and moved the finish line further. That is not a math problem. That is a behavioral architecture problem. And it's the one almost no financial content names directly. There's a guy, I'll call him Derek, from a financial planning case study I read a few years ago. 39 years old, earns $220,000 a year as a management consultant in Dallas. Feels financially stressed. Not ironically stressed, actually stressed. Lying awake at 3 a.m. stressed. He saves about $40,000 a year, which sounds like a lot until you see that his annual spending is $180,000. His FI number calculated correctly at 25 times his expenses is $4,500,000. At his current savings rate, assuming a 7% average annual return, he hits that number at 62. Not great when your identity is built around the idea that you're winning. His college roommate, I'll call him Paul, teaches high school in Columbus, Ohio, earns $58,000 a year, spends $32,000, maxes his 401k, holds broad index funds and a taxable brokerage account, has never owned an individual stock in his life. His FI number is $800,000. He hit it at 52. He still teaches 3 days a week because he genuinely likes 17-year-olds arguing about history, not because his landlord requires it. Paul cleared the gravity well. Derek is still burning fuel on the launch pad and wondering why the engines feel so loud. The point is not that Derek lacks intelligence. Derek is objectively brilliant at his job. The point is that Derek never ran the arithmetic. Nobody told him that each upgrade to his lifestyle was not a reward. It was a future tax on his own freedom compounding forward at the same rate as his portfolio. Stay with me because this next part changes everything. And it's the section that mainstream financial media avoids because it requires admitting something uncomfortable about how compound interest behaves. Specifically, when you are withdrawing money rather than accumulating it, you've cleared the gravity well. You've hit 25 times your expenses. You retire. You start withdrawing 4% per year. And historically, that should work fine. And statistically, it does most of the time. But here's the variable that almost nobody puts in the retirement calculator. They hand you on a brokerage website the sequence of your returns. Here is the math, not metaphorical actual arithmetic. Imagine two people, call them left path and right path, who both retire with exactly $1 million and both experience the exact same average annual return of 7% over 30 years. Identical average, identical portfolio size at the moment of retirement. The only difference is the order in which those returns arrive. Left path experiences a brutal early sequence. Negative 8% in year 1, negative 12% in year 2, negative 22% in year 3, followed by strong returns in the later decades. Right path gets the strong years first and the brutal drawdown late. 30 years later, left path's portfolio is depleted, gone. Not depleted because of bad average returns, because of bad sequencing at the worst possible moment. Early retirement when withdrawals are highest relative to portfolio size, right path with the same average return ends up with over $2 million. This is called sequence of returns risk. It's the thing that destroys retirement plans that look correct on paper. The mechanism is simple. When you withdraw money during a market decline, you're selling shares at their lowest prices. Fewer shares remain to recover during the subsequent rally. The compounding engine loses mass exactly when you need it most, and you can't undo it by waiting for the recovery because you already sold into the bottom. The structural solution is a 3-tier buffer that Vanguard and BlackRock both reference in their withdrawal phase planning frameworks. Tier 1, 18 to 24 months of living expenses held in cash, money market funds, or very short-term treasury securities. This earns almost nothing in real terms, but it buys you time. In a down market, you live off Tier 1 and leave your equity portfolio completely alone. You don't touch it. You don't rebalance out of it. You wait. Tier 2 is your medium-term bridge bonds, dividend-generating equities, REITs, instruments that produce income with lower volatility than pure stock exposure, 3 to 7 years of expenses. This tier refills Tier 1 as it depletes slowly enough that you're almost never forced to sell growth assets at an inopportune time. Tier 3 is your long-term compounding engine, broad index funds, total market exposure, the thing that actually grows over decades. This tier should not be touched in the first 15 to 20 years of retirement unless the other two are overflowing into it. It just sits there, compounding, protected from short-term noise by the structure around it. The 3-tier system doesn't require more money. It requires different organization of money you already have, and it means you've specifically engineered immunity to the one risk that destroys otherwise correct plans: panic selling at the bottom because your cash runway ran dry and you had no choice. By the way, hit subscribe if you like the content. Otherwise, the algorithm may never show you these videos again. The point is not that Derek lacks intelligence. The point is new research drops every single week. Financial advisor slides a prospectus across the table. Our fund is projecting 8% annual returns. Client nods. The fund delivers 4.3% after management fees, fund expense ratios, and the advisor's comprehensive wealth planning fee. 20 years later, client has a very optimistic projected number and an actual number that's 60% of it. Not rage, amused, tired, disappointment. That's my reaction every time. Now, here's the subplot I want to introduce, and this is the psychological dimension that threads through everything from this point forward, because it explains why a surprisingly large number of people hit their number and still feel broke. There's a woman, I'll call her Sandra, from a behavioral finance study published in the Journal of Financial Planning in 2021. She spent 24 years building toward a FI number of $200,000 based on her actual spending of $88,000 per year. She hit the number at 57, she retired. Within 14 months, she went back to work part-time. Not because the math failed, the math was fine. She went back because the anxiety did not stop. This is the part that almost no financial content addresses because it's not comfortable to say, and it doesn't sell anything. The fear that drove the accumulation, the vigilance, the obsessive tracking, the lying awake at 3 a.m. running mental calculations, that fear does not automatically dissolve when the portfolio hits the target. For a meaningful segment of disciplined, high-achieving people, the dread of financial insecurity is wired at a level that no balance sheet reaches. The number was never the variable. The fear was the variable. And the fear had been misclassified as a math problem when it was actually a neuroscience problem. Research in behavioral finance consistently finds that people who experienced financial instability during childhood carry measurably elevated financial anxiety across all subsequent income levels, including high ones compared to people who grew up in financially stable environments. Their nervous systems learned early that resources can disappear. That lesson doesn't unlearn itself just because your Vanguard account hits a milestone. You can have $2,500 invested and still feel the same low-grade dread you felt at 23 with $400 in checking. The practical response to this is not therapeutic, it's empirical. What anxious, high-net-worth individuals consistently lack isn't a larger number. It's a visual, data-driven model of exactly how robust their number actually is across a wide range of catastrophic scenarios. Most people who've accumulated $2 million have never actually run a Monte Carlo simulation, a computational model that tests their portfolio across 10,000 different randomly generated market sequences and watched what percentage of those scenarios still ended with a positive balance after 30 years. When you run that simulation and see that your portfolio survives 92% of all historically modeled 30-year windows, including windows that opened on the eve of the Great Depression, the rational brain gains traction in the argument it's been losing to the amygdala for years. The anxiety doesn't disappear, but it loses its logical basis. And when emotion loses its logical basis, it gradually loses its authority over the decisions. And Derek, the consultant from Dallas, his situation has a different texture than it appears. His spending at $180,000 a year is not recklessness. It's defense. The lifestyle inflation that's inflating his FI number to 4.5 million isn't irresponsibility, it's identity. Every visible upgrade is a signal to himself and to the people around him that he's made it, that whatever instability defined his earlier experience is not the current reality. He is not buying things, he is buying confirmation. And confirmation, as anyone who's tried to purchase it knows, has no ceiling. You cannot spend your way to security because the mechanism that demands the spending was never calibrated to recognize security as an input. Understanding that doesn't automatically change Derek's behavior, but naming it accurately changes what the solution actually is. And the correct solution is never earn more. It's get specific about what the spending is actually doing for you and find out whether it's working. But here's what nobody is telling you about the mechanical path to hitting the escape velocity number. And this is the specific arithmetic insight that separates people who actually get there from people who perpetually plan to. There is a calculable specific point in every accumulation journey where compound interest begins contributing more annual growth to your portfolio than your own contributions do. Not metaphorically, literally. There is a year, a specific 12-month window, where the market's return on your existing balance exceeds the total amount of new money you deposited that year. After that year, even if you stopped contributing entirely, the compounding engine would continue growing your wealth without you. This is pure mathematics. If you have $300,000 invested in broad equity index funds earning an average of 7% per year, the market contributes $21,000 in growth. If you're contributing $2,000 per month, $24,000 per year, you're still doing slightly more work than the compounding is. But at $500,000, that same 7% generates $35,000 in growth annually. Now, compounding contributes more than most Americans save in a year. At $700,000, it's $49,000 of market-generated growth per year, and it accelerates from there with no additional effort from you. The engine has reached self-sustaining thrust. The implication is that the early painful accumulation years when you're grinding, saving aggressively, and watching a portfolio that barely seems to move are wildly disproportionately important. Not because of what those contributions are in the moment, because of what they become. $1 invested at 32 years old is worth approximately $14 at $62 at a 7% real return based on the rule of 72 applied over 30 years. That same dollar invested at 42 is worth approximately $7 at 62 hours. You lose half the compounding power by waiting 1 decade. That is not motivational framing. That is arithmetic applied to your actual timeline. Most financial content presents compounding as a reward for patience. I'd argue that's the wrong frame. Compounding is a penalty for delay. Every year you wait is not a neutral year on a neutral timeline. It's a year during which you paid the maximum possible cost for procrastination. The gravity well gets deeper the longer you wait to launch. There's an old story about planting trees. A ruler asks a wise person when the ideal time was to plant a tree. The wise person says 20 years ago. The ruler says, "What's the next best time?" The wise person says, "Today." The internet attributes this to various cultures, none of which I can verify, but the arithmetic is unambiguous, regardless of who said it first. Here is the specific mechanical path broken down by phase, because generalities are useless when you're trying to calibrate action. Below $100,000 invested, your highest leverage variable is your savings rate. The compounding engine is too small to matter much yet. Debating which index fund to hold or whether to tilt towards small cap value is the equivalent of arguing about seat configuration while the rocket is still on the launch pad. Save more. That's it. Any additional dollar directed away from consumption and toward investment at this stage has a future value of approximately $14 at a 7% return over 30 years. Spend that hour on savings optimization, not fund selection. Between $100,000 and $300,000, your savings rate still matters enormously, but cost minimization starts to compound meaningfully. The difference between a 0.03% expense ratio, which is what Vanguard's total stock market index fund charges, and a 1.2% actively managed fund, is not a rounding error at this balance level. Over 20 years at a 7% gross return, a 1% annual fee on $200,000 costs you approximately $260,000 in lost compounding. That is not a projected figure designed to shock you. That is compound interest applied to the fee drag at standard historical equity returns. The fee compounds against you with the same mathematical ruthlessness as the return compounds for you. Above $300,000, the dominant variable shifts again. Tax optimization becomes the highest leverage action available. Specifically, maximizing tax advantage contribution space, Roth conversion ladders during lower income years, an asset location strategy, meaning the deliberate decision about which assets live in taxable accounts versus tax-deferred accounts versus tax-free Roth accounts. Growth-oriented dividend-light assets belong in taxable. High dividend and bond income belongs in tax-deferred. REITs, which generate ordinary income, belong in Roth or tax-deferred. At $300,000 and above, a fee-only fiduciary financial planner who charges by the hour not as a percentage of assets, not on commission, can return multiple times their cost in optimized tax treatment alone. The word fiduciary matters here, and I want to be specific about why. A fiduciary is legally required to act in your interest. A broker is legally required only to recommend products that are suitable for you, which is a dramatically lower standard that allows for recommending products with higher fees and commissions as long as they can be characterized as appropriate for your situation. The word financial advisor is not regulated. Anyone in the United States can legally call themselves a financial advisor without any license, credential, or fiduciary duty. The word fiduciary is regulated. Ask for it explicitly. If someone you're paying for financial guidance is not a fiduciary, you are paying them to recommend what is suitable for them first and suitable for you second. Our actively managed fund outperformed the S&P 500 in 3 of the last 12 years. That's great. A coin flip goes your way about half the time, but it doesn't charge you 1.2% annually for the privilege. Let me make the entire framework concrete with one realistic scenario. Lisa is 43 years old. She earns $94,000 a year as a senior project manager in Phoenix, Arizona. She has a mortgage on a home appraised at $380,000 with $210,000 remaining on the loan. She has a 401k through her employer with a 50% match up to 6% of her salary and a current balance in that account of $112,000. She opened a taxable brokerage account during the pandemic with $38,000 in it held in broad market ETFs, total invested $150,000. Lisa spends approximately $52,000 per year after taxes, including her mortgage payment. Her FI number at 25 times actual spending is $300,000. She is $150,000 into a $1.3 million journey, which sounds overwhelming until you run the math with real inputs instead of feelings. She currently contributes $5,640 annually to her 401k to capture the full employer match. Her employer adds $2,220. She contributes $600 per month to her brokerage. Total annual contribution across both accounts, approximately $15,660 at a 7% average annual return. Her existing $150,000 of invested assets will grow to approximately $572,000 in 15 years from compounding alone without a single new dollar added. But she is adding dollars. At her current contribution rate, she reaches $300,000 in approximately 17 years. She's 60 years old. acceptable, but not remarkable. Now, watch what specific decisions do to that timeline. The IRS 401k contribution limit in 2026 for someone Lisa's age is $23,500 annually. She's currently contributing $5,640. If she maximizes the 401k, instead of stopping at the match threshold, she adds $1,760 additional pre-tax dollars per year while simultaneously reducing her taxable income, which has downstream effects on her marginal tax bracket. She can also open a Roth IRA. The 2026 contribution limit for her age and income bracket is $7,000. Tax advantage space she's currently leaving completely empty. With 401k maximized, Roth IRA funded, and brokerage contributions maintained, her total annual contribution rises to approximately $37,700. At that rate, same 7% average return, she hits $1,300,000 in 13 years. She's 56, but her mortgage will be paid off in 14 years. When it clears, her annual expenses drop by approximately $14,000, and her FI number drops with them to $950,000. She actually crosses that lower threshold at around 53 years old. That's 3 years of her life returned to her by doing the arithmetic specifically instead of approximately. No stock picks, no leverage, no timing the market, index funds, contribution maximization, and a clear target. Sandra, the woman from the behavioral finance study who went back to work after hitting her number, eventually stopped again. Not because the anxiety disappeared on its own, but because she ran the Monte Carlo simulation enough times, watched the 93% historical survival rate across enough different catastrophic market scenarios that the rational brain finally won the argument it had been losing for decades. Her portfolio is at $2,700,000 now. She gardens. She travels in shoulder season when airfare is cheap and hotels negotiate. She cleared the gravity well. The gravity still has opinions about her. She just has enough velocity that they don't determine her trajectory anymore. 3 practical takeaways specific to this topic, not generic retirement advice.